Today we saw no change in interest rates, even though there's been a lot of talk on when U.S. interest rates will rise. In Canada, our most recent move was a rate cut in January. So what's next for Canadian interest rates? We'll look at what key U.S. data to watch and why the next Bank of Canada outlook in July is important. David Tolk, Chief Canada Macro Strategist at TD Securities. So the big news was really no news today in Canada. What needs to happen between now and the next big one in July?
Well, I think a couple of things need to occur. First is we need to really see some strength in the U.S. economy. So if you remember, the start of the year for the U.S. economy was quite a challenge. There were lots of weather impacts that slowed the economy. There were some supply chain disruptions related to a port shutdown in the West Coast. And as a result, we saw a very weak quarter. And really, the Bank of Canada sees this quarter as well and needs the U.S. economy to help contribute to Canada's own economic recovery. So really, the expectation is that on the degree to which the U.S. will be able to bounce higher from its Q1 soft patch. And if that occurs, then the Bank of Canada is quite comfortable leaving rates on hold and letting that recovery filter into the Canadian economy. If, however, that economy, or if the bounce in the U.S. does not occur, there's going to be a little bit more pressure on the bank to maybe sound a bit more cautious, trying to do all they can maybe to weaken the currency to help at least give exports a fighting chance against a still sluggish U.S. backdrop.
So what are those key pieces of U.S. data that we're looking for?
Yeah, I think we can break down the U.S. data into two camps. The first is really that's tied to the U.S. Domestic economy, and that is largely a weather type story, and some of those have started to bounce higher into the second quarter. But maybe a little bit more of a source of concern is just some of the data tied to more of the global economy in terms of manufacturing data, export data. That really hasn't shown up in the same degree as we would like to see. So I think there could be a couple of factors that are going on there. The first is that the global economy may not be strong enough to really act as a strong destination for U.S. exports. As well, what we've seen over the last year or so is a lot of strengthening in the U.S. dollar, and that tends to erode some of the competitiveness of U.S. exports. So those factors, I think, are both weighing on that part of the economy, and I think at some point we'll need to see either some improvements in global demand or at least some caution on the part of the Federal Reserve to suggest that interest rates won't be hiked very soon, and as a result, that will help to weaken the U.S. dollar.
Now, what about employment data in the U.S.?
Yeah, employment is quite important from the perspective of the Federal Reserve. It's one of their key metrics that they look at. And what we have seen in the labor market side is a fairly steady improvement in the pace of hiring. And I think that certainly does act as an important precondition for the Fed to think about rate hikes. But they know that if there's a risk, if they go too soon, they may end up stifling the recovery, which will then hurt the labor market. So their natural bias, I think, is to wait a little bit longer, making sure that they get a clear, sustained momentum in employment, and as well in terms of some of the wage growth that they look at, because wages will feed into future inflation, and that's the other part of their mandate.
So where will interest rates go next in Canada?
Yeah, I think it may be a very prolonged stay on the sidelines. So in the United States, we anticipate that if all goes according to plan, the U.S. economy will bounce through the second half of the year, and that will give the Fed enough evidence to suggest that they can start raising rates maybe by September. From the Canadian context, however, I think the shocks that have hit Canada might take a little bit longer to filter through. And as a result, we would anticipate the Bank of Canada will err even more on the side of caution and probably wait roughly a year or so after the Fed starts moving before they think about taking interest rates higher.
Any expectation for a cut before we do a hike?
I mean, that's the risk. So if the U.S. economy falters in the second quarter and we don't see this expected rebound, then we look across the Canadian economy and realize that there aren't very many growth engines left. We can think about still the shock to business investment from lower oil prices, and really the emphasis is on the non-energy export sector. And if the U.S. economy isn't performing well, that part of the export picture doesn't look particularly bright either. And then we look across the domestic economy, and I think here we can recognize that the household sector has taken on a lot of debt. Governments are trying to maybe scale back a little bit of their spending, and it's hard to see a world where Canada can really grow at a robust rate without that U.S. support. So if that U.S. scenario doesn't materialize, then there might be a little bit more pressure on the Bank of Canada to think about another rate cut towards the middle to the end of this year.
All right, very interesting. Thank you very much, David. I've been joined by David Tolk, Chief Canada Macro Strategist at TD Securities. I'm Marianne Deveni. Thanks for watching.